Welcome to the Deep Dive. Today we are cracking open the latest results for Lemon Tree Hotels.
And this is a fascinating one.
It really is. Here's a company that just pulled off a genuine financial high-wire act. They posted record Q2 revenue for FY26.
Their highest ever for that quarter.
Exactly.
Yeah.
And they did this while facing, these massive global and local headwinds that hit the entire hospitality sector.
That's the paradox we have to solve, right?
Yeah.
It sounds completely counterintuitive. How do you hit peak performance when the whole environment is, well, getting worse?
So that's our mission today. We're going to unpack these Q2 and H1 FY26 results.
And we'll focus on how they managed that revenue growth while costs were also rising, or maybe were deliberately being pushed higher. We'll also get into their huge expansion plans.
And critically, how market analysts are looking at their future. For this, we're diving into LTH's detailed investor presentation from November 2025.
Which gives us all the raw numbers.
And we're pairing that with some third-party technical stock analysis to give you that full 360-degree view. Okay, let's get into it.
We have to start with the environment. What was the market actually like?
Right. What were they up against?
Well, management used the term multiple headwinds, and they were not exaggerating. The list of external shocks is pretty long.
Like what?
You had increased geopolitical tensions globally, major local flooding. There was even an airplane accident, which always hits travel confidence.
Right.
Plus tariff wars, changes to GST. They said it all combined to create muted demand for the entire sector.
That context is so important because that's the storm they were sailing through.
It is.
And here's where the performance just, jumps off the page. Despite all that, Lemon Tree delivered its highest ever Q2 revenue.
The number was Rs 308 crore.
Which is an 8% increase year over year.
Mm-hmm.
That YOY growth is so crucial. It means they grew 8% against the same quarter last year.
And that success on the top line, it flowed right down to the bottom. It shows really strong financial management.
So profit after tax, or PAC,
that grew even faster than revenue. It stood at Rs 41.9 crore, which is a 20% jump year over year.
wow.
Even cash profit, a good measure of liquidity, was up a solid 9.2% to Rs 76.3 crore.
And if you zoom out and look at the whole first half, the 6 months up to September, the story gets even stronger.
Right, the H1 numbers are even more impressive.
Revenue up 13% to Rs 625.4 crore. And PAT was up a staggering 63%.
63%. That really suggests they hit some kind of inflection point in the first half.
They did, but this brings us to, I think, the first real puzzle here.
The margin compression mystery?
Exactly. Because despite that record revenue, their net EBITDA only grew by, 1%?
Just 1% year over year to Rs 132.4 crore.
So wait a second. Revenue is up 8%. Profit after tax is up 20%. Why is EBITDA, that key operating profit metric, practically flat?
Well, that's the thing. That 1% growth meant their net EBITDA margin, which is just EBITDA divided by revenue, it dropped by 306 basis points.
306. So that's over 3 percentage points of operating margin.
Yeah.
Just gone.
Gone. It settled at 43%. So what's happening?
What is happening?
This is the intentional part of the story. Management was very clear this was a deliberate, controlled spend to set them up for the future.
So not a mistake.
Not a mistake. They said the margin drop was because of increased, and this is the key, non-recurring investments.
In what areas?
3 main things: speeding up renovations on existing hotels, big upgrades to their tech infrastructure, and a one-time ex gratia payment to their employees.
So these are things that hit your operating line, but they aren't part of the normal day-to-day cost of running the business.
Precisely. They are accepting short-term pain for long-term premiumization.
They actually put a number on it, didn't they?
They did. They said those specific expenses, the reno, the tech, the bonus, accounted for 8% of total revenue in Q2.
So there's your margin. That's exactly where it went.
Exactly. And the forward guidance is maybe the most interesting part here for investors.
What are they projecting?
Management expects these costs to fall to about 5% of revenue next year, in FY27, and then stabilize at a much lower 2% by FY28.
So they're explicitly telling the market, look, this pressure is a strategic choice and it has an expiration date.
That's the story.
It sounds great on paper, but you have to be critical, right? They're projecting costs dropping from 8% to 2% in 2 years. That's a big drop.
It is.
So given the scale of the renovations and the instability they already mentioned, what's the execution risk here? What if they miss that FY28 target?
That is the central question, and it's why everyone is watching their operational metrics so closely. But to their credit, they provided some really strong, concrete examples.
To prove that the investment is already working.
Yes, to show it's already yielding immediate returns.
Okay, so give us that aha moment. How is this spending paying off right now?
Well, you see it in a couple ways. First, they finished major upgrades in key cities like Delhi, Bangalore, and Hyderabad. But the best example is the Red Fox Hotel at Arasati, Delhi. They renovated it and rebranded it as a full Lemon Tree hotel.
And that rebranding lets them command higher prices.
Significantly higher pricing. They call it repricing, and it starts hitting the books from Q3.
So a better brand means better rates, which immediately helps offset that reno cost.
That's it. And the second example is even more striking. They renamed a Keys Select Hotel in Pune to the higher-end Keys Prima brand.
And the result?
This repositioning on its own led to a 47% increase in revenue per available room, or RevPR, year over year.
47%. That's a massive jump in one asset's earning power.
It is, and it confirms that the short-term margin hit is delivering, this disproportionate pricing power pretty quickly.
Okay, a 47% RevPR jump is huge. But how scalable is that? I mean, that's the real question for their 121 existing properties.
It is, and it all comes back to the core health of their owned and leased hotels, and those metrics are strong.
Let's run through them. What was the gross average room rate, the ARR?
That hit ours 6,247, up 6% year over year. Occupancy was almost 70%.
69.8% to be exact.
Which was an increase of 139 basis points.
And when you combine the rate and the occupancy, you get that critical metric, RevPR.
Which was up 8%, hitting ours 4,358. And it's these strong operational results that form the backbone of their financial stability.
Especially when it comes to debt.
Especially debt management. They've been extremely disciplined there, which you have to be when you're funding this kind of expansion.
So how much did they cut?
Gross debt fell by ours 212 crore year over year. It's now sitting at ours 1,610 crore.
And that massive reduction helps their borrowing position, right?
Absolutely. Because performance is up and debt is down, their credit rating actually improved from A to A+.
And that's not just a nice to have. That has a real financial impact.
A very tangible one. It lowered their cost of borrowing to 7.72% in Q2. That's down almost a full percentage point year over year.
And that interest saving goes straight to the P&L.
Straight to the bottom line. At the same time, their overall leverage picture improved dramatically. The debt-to-equity ratio fell from 1.14 times
down to a much healthier 0.86, which tells you the company is less reliant on borrowed money.
Right. And that's crucial when you're about to undertake a massive expansion. It gives you flexibility.
Which brings us perfectly to the pipeline. And the scale of this is, it's staggering.
It really is. Lemon Tree is essentially running two companies at once, the one they have now and the one they're building.
Their total inventory is 242 hotels, over 20,000 rooms.
And here's the kicker.
Half of that 121 hotels is operational. The other half, another 121 hotels, is just sitting there in the pipeline.
They are preparing to literally double their size.
And they're doing it with an asset-light model.
Which is key. Asset-light means they're focusing on managing hotels for other owners, not tying up billions buying the land and buildings themselves.
So the capital risk is on the owners, not on Lemon Tree.
Exactly. And you can see the payoff right in the numbers. In Q2 alone, they signed 15 new management and franchise contracts.
Adding over 1,000 new rooms to that pipeline.
138 new rooms, while also opening 5 new hotels.
And the financial benefit shows up in their fee income.
Right. Total management fees were up 8% in Q2. For the whole first half, they were up an even more impressive 18%. That's the low-risk, high-margin revenue that investors love.
Okay, so beyond just the sheer number of hotels, what about the quality of the pipeline? They're clearly pushing towards premiumization.
Very much so. Their luxury brand, Aurika Hotels and Resorts, is the absolute star performer right now.
What are those numbers looking like?
Aurika showed a 32% increase in RevPAR year over year. But even more telling is the EBITDAR. That's a key hotel profitability metric.
Right.
Aurika saw a phenomenal 46% increase in hotel-level EBITDAR per room. This is why that renovation and rebranding strategy is so important.
It drives profit in their highest margin segment. And what about regionally? Any standouts?
Mumbai. It had the highest RevPAR growth in the entire portfolio, up 22% year over year. And occupancy shot up by over 1,600 basis points.
And finally, there's the big, long-term strategic play.
The letter of award for that huge plot of land in Nehru Place, New Delhi.
This is for another Eureka, right?
Oh,
A massive one.
A massive one, 500 plus rooms.
So what's the implication of owning a flagship asset of that scale in a city like Delhi?
Management sees this as a foundational advantage for the next decade. Nehru Place is a prime spot, and a hotel that big is rare for the area.
So they'll have very little new competition.
For the foreseeable future, yes. It means they should be able to capture outsized revenue and pricing power. It's a huge bet on the future of premium travel in the capital.
Okay, so we've covered the internal story, the strategy, the ambition. Let's pivot now to the external view. How is the stock actually performing?
Well, what's fascinating is the tension between the long-term trend and the short-term picture. The technical analysis confirms the stock is in a broad, long-term uptrend, a really clear, bullish structure that's been in place since early 2021.
So fundamentally, the market buys the growth story.
It seems to. However, the current price action shows weakness. The stock's trading near Rs 148, which suggests some profit-taking after it peaked up near Rs 175.
And this is where analysts look for those key support levels, the moving averages.
That's right. The most critical short-term safety net is the 50-week moving average. That creates a support zone between, say, Rs 140 and Rs 145.
And if it breaks below that?
That would signal a deeper correction. The long-term floor, the one that really shouldn't break in a bull market, is the 200-week moving average, way down around Rs 118.
And what about momentum? We looked at the Relative Strength Index, the RSI.
The RSI is sitting at 43.85. A read in below 50 suggests neutral to slightly bearish momentum. So it confirms that short-term selling pressure, but it's nowhere near being oversold.
So the technicals are a bit cautious right now. But what about the analyst coverage? The street view.
That remains very aggressive. Sell-side analysts are highly constructive. They've generally got a strong buy call on the stock, with price targets pushing up towards Rs 200.
And they're basing that optimism on some pretty serious growth forecasts.
Oh, yeah. Consensus projections are calling for earnings growth of 25 to 26% per year and revenue growth of 11 to 12% per year for the next few years.
And that kind of compounding growth is what fuels a buy rating.
It is, and it's all underpinned by this massive structural driver. India's branded hotel penetration is still incredibly low, single digits.
So there's just a huge runway for growth, especially in that mid-market segment where LTH is so strong.
Even as they push upscale with Aureka, that runway is undeniably long.
But we have to acknowledge the risks that could derail this, right? We can't just accept the narrative.
No, we have to look at the structural risks. Analysts point to near-term volatility from rising operating costs and just the natural seasonality of the business.
And what about the balance sheet?
Well, while they've done a great job cutting debt, their interest coverage ratio, that's EBIT divided by interest, is still a bit thin, around 1.5 times. They need operating profit to keep growing faster than their interest payments.
And then there's the big one.
Execution risk.
Doubling your portfolio, adding 121 hotels. That is an enormous logistical challenge.
It's a huge challenge. Any slowdown in that timeline puts that projected 25% earnings growth at risk. The pipeline is the asset, but managing it is where the rubber meets the road.
And just before we wrap up, a quick mention on ESG for those who follow it. LTH has set some specific targets for FY26.
Right. A 15% cut in energy use, 10% in water, and a goal of having 30% of their workforce be opportunity-deprived Indians.
So synthesizing everything we've looked at today.
Lemon Tree Hotels is in this really complex financial period. They are deliberately spending on long-term premiumization, renovation, tech, branding, and that's causing a planned short-term hit to margins.
But the strategy seems to be working.
Operationally, it's clearly working. It's yielding higher RevPAR, and it's strengthening their core balance sheet.
So what does this all mean for you? The technicals show the stock is under some short-term pressure, sitting right near that critical 50-week support level.
But fundamentally, the company has been very clear that the margin issue isn't a demand problem.
No, it's due to strategic investments that are already showing success. I mean, that 47% RevPAR jump in Pune is hard to ignore.
Very hard to ignore.
So we have to ask, is the market just being cautious because of the execution risk, or is it being impatient? Will this short-term technical pressure give patient buyers a chance to get in before the full benefit of these renovations triggers the next rally towards that Rs 175 resistance level? It's a fundamental investment decision, really, about whether you're willing to buy into some planned short-term pain for that promised long-term gain.